Test, test.
Чому так добре?
Can you hear me?
Yes, hello.
Okay. Great. Should we start?
Just one moment. I think I forgot to announce the seminar on one channel. Okay, we can start. So today Ricardo will be talking about portfolios and Bitcoin.
Hello, everyone. I want to analyze, I analyzed already what is the effect of building a portfolio with traditional assets and trying to incorporate cryptocurrencies in it. Let me show my screen. You can see my screen now? Can you see my
Yes,
screen now?
yes.
Okay, we're going to see portfolio optimization. And well, first I tried to build a portfolio of just classical assets, just like bonds, well, all these are indexes like ETFs, with principal asset classes like equity, real estate, commodities, and bonds. I use R to do that. I use this library called QuantMoon, where I can put like just the ticker, and I get the data. For example, for this special case, I use Standard and Poor's, a commodity bond index, and a real estate index, and also a bond index. You can see that these indexes are exist. You can go to Yahoo Finance. These are tickets from Yahoo Finance, so you can put it here. You can see the whole history, and also you can download it with the R. I mean, you can see the returns, all kind of things like close and price to earnings also. So, for example, this index that I took to build my initial portfolio is ETF from shares, which is bonds that are 1 to 5 year to maturity. Well, I use these prices and I compute the standard deviation and the expected return for all of these assets. And then I use a theory called the the mean variance portfolio, which is in the sense calculating the return of the portfolio and the standard deviation, and also calculate the Sharpe ratio, which is just the division of the portfolio return by the standard deviation, and I try to maximize this Sharpe ratio with each of the weights of these assets. I don't know if how clear is this to you.
Yeah, I'm not really so knowledgeable in this financial mathematics. Um,
Okay.
can you explain? So first, what is the return of the portfolio? This is you start with a certain amount of money, and you after some time, the amount of like the value of your portfolio changes, and this difference is the return, basically.
Yeah. Well, first I have to compute the return of the asset itself. Choose the return, the daily return, the average of the daily return, and also the standard deviation of each asset, which is just the standard deviation of the returns. And then I took the weights, which is the percentage of the portfolio of each. What is the percentage of my money that I want to invest uh, in this particular asset? And in order to calculate the portfolio, the return of the portfolio, you just have to multiply each of these weights for the standard for the expected value, well, for the expected return of these assets. Let me just show you like the formula. Well, here we can see that R RE means the return of each of our assets, and P is the allocation, the weight of each asset in our portfolio. In order to calculate the expected return of the whole portfolio, we should multiply the expected return of each asset by the expected weight of each asset in the portfolio.
So,
Well,
is this for just one day? So you just compute the return for one day?
Well, you could do it that way, but you could compute the return of a certain period of time. In this case, I use 2 years, and then I multiply for the weight. And this is just one part of the equation of their Sharpe ratio. Also, we have to compute the standard deviation, and the standard deviation. To calculate the standard deviation of a portfolio, we should look also. Well, we should look at the variance and what is the correlation between these assets. That's why it's not that simple to just sum all the standard deviations. You can sum standard deviation.
One question.
Yeah.
Can you turn off your mic first, please? Or someone has their mic on. Ricardo?
Yeah.
Can you turn off your mic?
Question? Yeah. Again, please.
Can you turn off your mic?
Oh, sorry.
Okay. Sorry. So I think when I speak and there is your mic gets the sound, so you get echo. Can you explain? So you're talking about standard deviation. So what I know is that standard deviation is something that measures some random, a measure for a given random variable. And what is the random variable that we are looking at here?
Well, here we are looking for the randomness of the returns of the assets. So we want to measure what is the expected value. Well, first let's go back to the just the assets, which are, for example, this ETF of bonds. So we, in order to calculate the expected value of the returns for this instrument, for this asset only, you just have to take the daily returns and then you have to take the average of that, and the average of your returns, it's the expected return of this asset. Okay.
Okay.
And then what are you measuring with the standard deviation is just how much is in the daily returns are deviating from the mean.
Okay.
And this is just the standard deviation of the historical returns. In this case, we were 2 years. But when you put it in portfolio context, you have to add the weights, and there's a special mat for that.
Okay, understand. Thank you.
Okay. Well, this is the first step to get the expected value and the standard deviation of each asset, and then you will get for in this case I will get a 5 expected returns and 5 standard deviations. Which you have to multiply the weights by the expected return previously calculated with the historical returns, daily returns. So in order to calculate the standard deviation, we have to account for the correlations between the assets. And well, this is the formula. I'm going to be very technical, but here what it says is that you just have to take account the weights of each assets, and also take this are the correlations between those assets. So if you have like a negative correlation, it's going to be have effect that you're going to lower the variance, or if you have positive correlations, you're going to increase the variance. So we're looking for instruments that lower my variance in order to have like a better Sharpe ratio, because you're going to have more return per unit of risk. I don't know if that's clear.
Yeah. Uh, yeah, I think at least personally, I understand it. So basically, you take a certain portfolio and you look at it for the some historical time, like let's say 2 years, and you model this portfolio as a multi-dimensional random variable, basically. So you have several assets, and each asset is the price of each asset is one part of this vector, or actually the return. I think you look maybe at daily returns or something is one part of this vector, and so you have for every day you have those vectors which give you the returns for each asset, and so this is like some kind of a random variable. And then you assume, okay, so in the future, we assume that this random variable will behave in the same way as it did in the past. So we can try to find a kind of a portfolio, which is like a choice of which ways to pick, which maximizes my return, but minimizes this standard deviation, because then so small standard deviation means that less risk. Yeah. So is it?
Yes, exactly.
Yeah.
We are looking to maximize the Sharpe ratio, which is like the return per unit of risk. So we are looking to maximize our return and try to lower the standard deviation of our portfolio. So in order to minimize, well, in order to maximize the Sharpe ratio, we should choose the portfolios that are lowering my variance of my whole portfolio. Okay, then I try to plot. Well, I simulate tons of portfolios. By this, I just randomly put the weights of these five assets, classical assets. Five for no four no excuse me is 4 classical assets, and I just compute the return and the volatility for this for these portfolios. So I have a spectrum, which is, for example, here it means that for each dot means the return of one simulated portfolio and the volatility. And we can see that, for example, if we want a portfolio with 10% of return with 6% of volatility, that's not possible, because we can see that we have a spectrum that we can kind of draw a line which are the feasible and unfeasible portfolios. Let's see in the next image. For example, here you can see the line, which is the efficient frontier. It's the maximum that you can get with these assets. For example, as I said before, if we have a portfolio, in the case that we will want a portfolio with 10% with just 2% of volatility, that's not possible. It's obviously that the return comes with volatility. So these are the possible returns with these four assets. So I try to incorporate Bitcoin in this portfolio of four assets, and I did the same. Here we have two spectrums, but we can see that in the gray spectrum, you can see that it's above the blue one, because I incorporate Bitcoin to this portfolio. So, for example, with a portfolio with volatility of 8, I can get a return of 15, which with the classical assets, I can get to that high. Also, I can draw a frontier to this spectrum. Where is the most I can get? For example, for adding crypto, I cannot get, for example, like 20% with just 2% of volatility. So the idea is see that by adding crypto to our classical assets, I can shift my spectrum and get higher returns with the same level of risk. And these are my final results. Here I have the maximum Sharpe Ratio portfolio, which it's a portfolio that is around here, which has 8% return with just 5% of volatility. That's the efficient portfolio, because I maximize my return per unit of risk. And for example, this is the allocation of my portfolio, which says that I should add like around 4% of Bitcoin to my portfolio in order to maximize the Sharpe ratio.
Okay. And what happens if you put 100% Bitcoin? What's the Sharpe ratio then?
Well, if you put 100% Bitcoin, the portfolio is going to be like around here, where I'm pointing. Well, that means obviously you're going to get a lot of return, and also you're going to get risk. The thing is that in order for this theory is that you have to maximize the unit of return per risk. So you have to lower the amount of volatility, but also you get more return per this volatility. So if you put it in this, you're going to lower your Sharpe ratio actually.
Okay, thank you. I have one question.
Yeah.
So, I mean, it seems to me, well, Bitcoin grew a lot the past years. For which period did you use the data?
I use from late 2017 till now.
Ah, okay, so this also includes the drop from
Yeah,
20,000 to 3,000.
this includes the drop. I didn't take the explosion. We will say in the last semester of 2017. I just took like uh, the bear market.
Okay, so yeah, that's actually very nice. So even in the bear market, it makes sense to have Bitcoin in your
Yeah,
portfolio.
yeah.
Okay. Uh, okay. Yeah, that's very interesting. And does this tell you when you should rebalance your portfolio, or should you just choose those allocations and keep them?
No, of course you have to rebalance. Well, obviously there's no perfect theory for rebalancing, but you can choose. You can do it. Well, it depends on your trading cost, but you can do it like monthly, and also depends on the conditions of the market. I mean, if you see like a big change, so you have to monitor in this portfolio.
But
If there's a big change, you have to rebalance for sure.
okay, and the goal is to keep those allocation
Yeah,
percentages.
yeah.
Okay.
The goal is to keep a location because you are in theory the weights shouldn't change too much, but it depends much on the history because and depends how much I mean, how often you're going to rebalance, because if you let it pass, like, I don't know, 6 months, obviously is going to change a lot.
Okay, thank you. That's very interesting for me. I didn't really know much about this theory until now, and I think I understood it. So thank you for the explanation. Does anyone else have questions?
Once I want to say thanks to Ricardo because I really like these pictures of like the efficiency, the boundary of efficiency of portfolios. So I've heard about
Yeah.
a lot about this, and now I'm happy to see this in the practice. So yeah, that's great. Could you share this picture so I can share it with my maybe friends? So just to show that the crypto is worth to include in the portfolios, because
Yeah,
yeah,
I can share that this
yeah,
presentation.
thanks.
So I don't know if it's okay for us, Sanko,
Yeah,
and for me it's okay.
Yeah, it's okay to share. You can share the whole presentation. Right now, this stream is public anyway.
Okay. Yeah, for sure.
yeah. And I have a question. So, if you go to one of these pictures,
Yeah.
how did you simulate the shares? So, I assume that you do it randomly. But
Yeah. I mean, these points in the spectrum, for example, the gray one, are just random, and you can see a concentration here because it's very difficult that you get, for example, last like Sanko said that 100% of Bitcoin portfolio because it's going to be like very high. So it's very difficult to get randomly 100% portfolio, but of course it will be I mean here more or less. But the frontier, the fishing frontier, tells you what is the most that you can get with this combination of assets.
Yeah, I know. So what I would suggest, not to do it randomly, but to create a grid of assets.
Yeah.
So for each combination, you have a point. So
Yeah.
I suspect it shows you like equally spread.
Okay,
Cloud
do
of
you
points.
mean like put like plot like representative of over common portfolios, right?
Some kind of, yeah.
Yeah, I mean like putting here like what is the where in this spectrum where is the equally weighted portfolio or that kind of thing, right?
So when you randomly simulate the points, so you see the area where the lot of portfolios concentrated, but you're not sure about the boundary, so you can plot it, but that's not in the best kind.
Okay.
Yeah.
That you mean that it's stratifying the sample, right?
Yeah, so if you do it like in a grid, in a determined way, so you will see the dots for all these blank spaces under the curve. So that would be, I think, more pretty visualization. Yeah, that's a matter of visualization, but I think it worth trying.
Okay. Yeah. Thanks.
Yeah, thanks.
I don't know if you have another question.
And do you have a platform including other cryptos, not only Bitcoin?
Well, actually, I do it for Ethereum. Also, the location here it's a little bit lower. For example, here I have the Ethereum results. Here I have this. I also get like higher returns with incorporating Ethereum, but I have like a lower allocation. This this is the one I get just 3% of Ethereum in the allocation for the same data. Just change Bitcoin by Ethereum.
Okay.
Yeah, I do it just for these two, but I also planning to make a portfolio of just crypto. But I think I will share it next time. I already did that, but maybe I share it next time or in the next session, or I don't know.
Okay. So how does Ethereum and Bitcoin compare? Is it better to invest in Bitcoin or in Ethereum or in both?
Well, I haven't mixed both, but you can see it actually in Ethereum. You get a higher return for more or less the same volatility, but it's actually I will invest in Ethereum because it has lower standard deviation. But as you can see, you have to put less at Bitcoin. I mean the allocation compared to to Bitcoin is that you put almost like 5% Bitcoin rather than just like 3%, which is this number.
So how does it happen? You put less and the return is higher? Is this because basically Ethereum has grown more than Bitcoin for the test period?
No, it is. You have to see this in the portfolio context. So, for example, here you're putting more in also in real estate. So it has to do with the correlations between. So in portfolio context, it's better. I mean, but it's if you have these assets in a specific. So real estate is contributing more to Sharpe ratio, and here Bitcoin is well in the Bitcoin portfolio. Obviously, Bitcoin is contributing more than real estate.
So there is some kind of correlation between real estate and Bitcoin or real estate
Yeah,
and
of course,
Ethereum?
of course. Yeah, of course.
Okay. Which one is has bigger correlation? Do you know? To
I
real
haven't.
estate, Ethereum or Bitcoin?
I don't know if I compute here. No, well, I can do it, and I can share with you later because I don't have it. I don't have the number here.
Okay. And the other thing that just came to my mind, so as the markets mature, I think this usually means that the correlations are expected to increase, right? So
Not
maybe
really.
no.
Well, not really, because, for example, gold is very mature and it's always like a good hedge. And for example, equity and bonds always correlates because, well, one kind of depends of. I mean, when there's like a growth, you invest in equity, and when there's a recession, you invest in bonds. Well, normally people invest in bonds, so there's like a negative kind of negative investing, but also it's very tight because these are the two main assets, and also for example, commodities. It's a very mature, so I will say, asset class, and well, they are not correlated.
No, I mean when Bitcoin and Ethereum mature, I don't know. I wonder because now they're not correlated so much with kind of the economy in general, maybe,
Mm-hmm.
but maybe they'll become more influenced by the general economy if they grow more.
Mm-hmm.
So the correlations will change.
Okay, yeah, yeah,
Eh,
but also I don't think that it will correlate more with, for example, equity, because it's like a different total different asset class.
Okay, and another thing. So um, when people use this modern portfolio theory for normal asset classes, for how long periods do they take to uh, get some data to build those models?
That's another thing. Usually do it like for 5 years of history, more or less. Well, obviously, more data, the better.
I guess the problem there is that if you take a very small period, you're not going to capture kind of all the states of the economy, right? So if you take a period where the economy is in a recession, this is not good. It will not give you a good model for when the economy is growing, something like this.
Yeah, of course. But also that it's the problem when you try to predict Bitcoin. You cannot say what is going to happen when you have like a recession, right?
Yeah. So I mean now we cannot really use very long periods. Maybe for Bitcoin, maybe we can, but for others, not so much.
Yeah, that's also the problem with when I was building the crypto portfolio, because you don't have, well, you have these altcoins that are just like for that are they are just like, I don't know, like half year or 1 year. So in order to this works, you have to have more data.
Okay, thank you. Any other questions? So if there are no other questions, then we can close the seminar. Thank you, Ricardo, for the presentation. And thank you all for listening and participating.
Thank you.
Have a nice day.
Thank you. Have a nice day.
Bye.
Thanks. Bye.